Can a monkey throwing darts pick stocks better than your financial advisor? Today we'll hear from two billionaires, one who says yay and one who says nay. I'm Ken Carpenter, and this is Invest AI Savvy, where AI powers smart investing. And today we're going to visit this very prominent theory on Wall Street, and that theory is concerning the random walk theory. And the random walk theory says that stocks go up and stocks go down based on completely random events. And there's absolutely no way to pick stocks correctly using technical analysis or fundamental analysis. Uh, Either way, you're doomed to fail. And according to this theory, the best way to invest in the stock market is by having a very large portfolio of stocks, at least 100 stocks, to diversify and make sure that some random negative event doesn't make you lose all your money because you just invested in one stock. Now, they're very prominent promoters of this theory, and they're very prominent critics of this theory. And so, one very prominent proponent of this theory, of the random walk theory, would be his name's Burton Malkiel. And Burton Malkiel actually wrote a book about this theory, a very uh, well respected investment book called A Random Walk Down Wall Street. The book was first printed in 1973. Mr. Malkiel has continued to write and produce new editions. So there's been now 10 editions of this book. And according to Mr. Malkiel, who, by the way, is a very prominent Princeton economist, he believes that there's no way to know what's going to happen with the company. There's just too many random events. And he backs this theory up by saying that index mutual funds consistently beat over time professionally managed mutual funds. That's his primary contention in the book, A Random Walk Down Wall Street. And he said before every edition of this book was released, he ran the numbers again and again confirmed that uh, these stocks, these randomly selected stocks that comprise of various index funds, outperform the professionally managed funds. So now, a very famous and popular critic of this theory, Warren Buffett, has based all of his stock picking on what he calls fundamental analysis, which he credits a gentleman by the name of Benjamin Graham from teaching him about. And so he bases his fundamental analysis on going through the company financials, looking at their profitability, looking at their earnings, looking at their forward projected earnings growth, and based on fundamentally analyzing all this information, he is able to come to a conclusion like, okay, this is a company that looks like there's going to be some major stock appreciation. And arguably, Warren Buffett has been right enough times to make Berkshire Hathaway one of the most uh, profitable and successful investment vehicles that's ever existed in the modern stock market. Uh, but now, a proponent of the random walk theory, another proponent and a very wealthy man, his name is John Bogle. And John Bogle actually was the founder of Vanguard Mutual Funds. And he was the one that said, based on this random walk theory, which is also backed up by another theory that sort of goes hand in hand with the random walk theory. It's the efficient markets theory. And, oh, I'm sorry, it's the efficient markets hypothesis. And the efficient market hypothesis says that the price at any time in the stock market, the price of a stock is already baked in, and the best indicator of the future stock price is the current stock price. So it's impossible based on the efficient market hypothesis or the random walk theory to select individual stocks. And that's why John Bogle said what you should really do is pick a huge index of stocks, a huge collection of stocks. For instance, every single stock in the S&P 500. Take those 500 stocks and then proportionately buy them based on their size in relationship to the valuation of all the companies in the index, and then reweight and repurchase or sell off that stock to constantly rebalance it within the index. And just by doing that, you're always going to have a better investment outcome than you would if you try to use technical analysis or fundamental analysis. So that's it. That's a random walk efficient market hypothesis. I'm Ken Carpenter. This is Invest AI Savvy, and that's the way it is.